Nobody tells you this, but that 8% return you're bragging about, you're not keeping 8%. You're keeping closer to 5. And that money market paying you 5%, you're walking away with less than 3. Most people have no idea how much wealth is quietly disappearing every single year. I want you to think of your investment account like a bucket that you're trying to fill up with water. Every year you pour in your returns to fill it higher, but there's a massive hole in the bottom of that bucket. Before you can even think about reinvesting a single dollar to grow your wealth, the government drains away 30 or 40% of what you just poured in. You're working incredibly hard to fill that bucket up, but it just keeps leaking out the bottom while you aren't looking. In this video, I'm going to break down exactly how much money you actually keep after taxes on things like money markets, bonds, and stocks. Once we look at those, I'm going to show you a tax-free alternative that changes the entire equation so you can actually keep what you earn. Let's start things off with money markets because it seems like everyone is really excited about them lately. Rates are sitting right now around 4 to 5%, and since we've dealt with a near zero yield for many years, seeing that 5% number feels like a major win for your savings. But here's the part that usually gets left out of the conversation. All that interest you're earning is taxed at ordinary income. It doesn't get the lower capital gains rate that most people talk about. So it's taxed at your full marginal rate, just like the money from your paycheck. If you're a high earner, I want you to run these numbers with me so you can see the damage. Your federal rate is likely 37%, and if you're making over $200,000, you're going to owe an extra 3.8% for net investment income tax, which most people just call NIIT. That adds up to 40.8% just for the federal level before your state even touches a single dollar of your profit. When you take a 5% return and multiply it by what's left after that 40.8% drain, you're left with just 2.96% in actual profit. Once you add in state income tax of maybe 5 or 10%, your real after-tax return is landing somewhere between 2.5 and 2.75%. The math gets even worse when you look at what's happening with inflation right now. Inflation is running around 3%, so if you're earning 2.75 on your money market while inflation eats at 3%, you're actually going backwards every single day. You're losing your actual purchasing power while you sit there watching a 5% number on your screen and feeling good about it. What makes this situation even more frustrating is that the tax hit happens every single year before you have a chance to reinvest your gains. This means you aren't compounding your interest on your full balance, but instead you're compounding on a much smaller base because the government took their cut first. Over a period of 10 or 20 years, that annual drain doesn't just cost you this year's taxes, it actually costs you every dollar those taxes could have grown to in the account if they'd stayed. That is the hole in the bucket that I was talking about. And while it doesn't look dramatic in the first year, it becomes enormous over a few decades. Now, money markets are really just the beginning of the problem. You need to see what actually happens to that 8% stock market return that everyone loves to quote when they talk about building wealth. People cite those 8% to 10% average annual returns like it's guaranteed money in the bank. But that number is gross and it doesn't account for taxes or the years the market drops. You also have to deal with fund distributions that trigger a tax bill even when you didn't sell anything. So what you actually keep is much lower. If you're trading actively or your fund distributes short-term gains, those are taxed as ordinary income at that high 37% tax rate plus NIIT. Your 8% return quickly becomes 4.5% after federal taxes, and once your state takes their share, you might even be looking at 4% or even less. Even in the best case scenario, you hold these positions for over a year and get long-term gains, the federal tax rate for high earners is still 23.8% combined. Your 8% return drops to 6.1% after federal taxes, and after state taxes, you're probably sitting somewhere around 5%. There's a concept called tax equivalent yield that usually makes people stop cold when they finally understand it. This is the return you would actually need to make in a taxable account just to match what you're keeping in a tax-free one. If you're at a 40% combined tax rate, a 5% tax-free return requires you to hit at 8.33% in a taxable account every single year just to break even. If you live in a place like California or New York where the combined tax rate hits 45%, you would actually need 9.09% return just to keep pace. You're pouring water into that bucket at 8%, 8%, but 40% of it is drained out before it ever even has a chance to compound and grow. Now, we need to talk about the move most people make when they finally want to feel safe, and that is jumping into bonds. You see, a 5% yield with steady income and no market chaos, so it feels like the responsible play for your portfolio. The problem is that you're running into the exact same tax wall because bond interest is taxed as ordinary income, which is the same way the IRS treats your money market accounts. By the time you hit the top tax bracket and add in NIIT and state taxes, you're only keeping around 2.5 to 2.75% of that gain. The yield is the same and the tax hit is the same, so the actual result in your pocket is identical to the cash accounts we just looked at. Bonds actually add a specific type of risk that money markets don't carry at all. If interest rates start rising after you buy your position, your bond is going to lose market value immediately, and that leaves you in a tough spot. You're either stuck holding that investment until it matures years down the line, or you have to sell it at a loss right now, and that definitely doesn't feel like a safe play anymore. Treasury bonds do give you one small break since they are exempt from state and local taxes, and while those savings are real, the relief is pretty modest. You still have to deal with federal taxes and the NIIT, so the government is still taking a massive bite out of your growth. A lot of people bring up municipal bonds as a tax-free answer to this whole mess. They do solve part of the problem because the interest is generally exempt from federal tax and sometimes state tax too. But the yields usually reflect that advantage by sitting down around 3 or 4%, and you're taking on credit risk with lower rated municipalities, and none of these bonds come with a death benefit or creditor protection. You also can't access your money whenever you want without penalty and triggering a taxable event, which limits your flexibility. Bonds might solve a tiny bit of the leak, but they don't fix the whole thing, and they'll usually hand you a bunch of new problems in return. Now that you know what you're actually keeping across these most popular options, I want to show you the alternative that eliminates the leak entirely. This is the part that really changes everything for your long-term wealth. When you use a properly designed whole life insurance policy, you're building cash value that grows tax deferred, which means there's no annual tax bill and no government drain before you reinvest. Every single dollar of growth stays inside the policy and compounds the full amount year after year rather than being chopped down every April. When you actually need to use the money, you can do it through a policy loan instead of a withdrawal. Borrowing against your policy is not a taxable event, so you don't have to worry about capital gains or ordinary income because the IRS simply doesn't touch it. If you compare that to selling off stocks or liquidating a bond position, you'll see that every dollar you pull out of those accounts usually creates a tax bill on the spot. Another huge factor is that when you pass away, the death benefit goes to your family completely income tax-free. No taxable account on the planet can do that for you. A standard brokerage account passes with stepped up basis, which is helpful, but it is still subject to estate issues and your heirs will still have to pay taxes on any future growth. The death benefit is just clean and simple. A well-designed policy from a strong mutual company is going to net you about 4 to 5% annually on your cash value. And the best part is that you keep all of it. Let's run that comparison that actually matters for your bank account. If you start with $100,000 in a taxable account earning 8% gross at the 40% combined tax rate, your real net return is only 4.8% after taxes each year. After 20 years, that balance grows to roughly $255,000. Now, if you take that same $100,000 and put it in a tax-free structure earning 5% with zero annual drag, you end up with approximately $265,000 after 20 years. The account with the lower gross return actually wins by $10,000 because it's compounded on 100% of its gains every single year instead of just 60%. If you stretch that timeline out to 30 years, the gaps get even dramatically wider because the compounding is unforgiving in both directions. If you feed it a smaller base every year, it's going to punish you quietly for decades, but if you give it the full amount, it rewards you at the same pace. I want to be straight with you that whole life has a lower gross return, and in those early years, the policy's going to take some time to break even. The power here isn't in some flashy headline rate rate, but in what actually compounds and what you actually get to keep in your pocket. You also don't have to deal with market risk because the cash value doesn't drop when the market crashes, and it is guaranteed to grow every single year. In most states, this money is protected from creditors like lawsuits, and unlike a 401k or IRA, there's no government cap on how much you can put in. The Rockefellers understood these mechanics perfectly. Old money families didn't build their wealth by chasing the highest gross yield they could find. They built it by protecting what they already had from taxes, lawsuits, and market swings while letting it compound untouched for decades. This structure isn't anything new, but most people just never get shown the actual math behind this. Most of us grew up thinking that the biggest number always wins, so we naturally assume 8% is better than 5% every single time. The problem is the big number is just the gross amount, which means it represents what goes into the bucket rather than what actually stays there for you to spend. When you start climbing into those higher tax brackets, that return percentage starts feeling like a bigger and bigger lie. Next time someone tries to sell you on a specific return, you need to ask them if that number is before or after the IRS takes their cut. You have to do the actual math because at a 40% combined tax rate, you need to earn 8.33% on a taxable investment just to keep pace with a 5% tax-free return. Most people never bother to ask that simple question, and that mistake kills their compounding power year after year without them even realizing it. Now that you see how this tax math actually works, you'll need to figure out how to set this up the right way for your specific life. If you happen to be a business owner, there is a very specific way to set up whole life so that you can run your premium dollars through a business and stack those tax advantages on top of what you're already doing. I break that down in the next video, so make sure to check that out. If you want to see how these numbers look for your personal situations, I put a link in the description where you can get started.